Tensions are escalating in the Strait of Hormuz, impacting global oil prices and financial markets. Meanwhile, the semiconductor sector is facing significant volatility and inflation concerns are rising. Here are today's top 10 stories you need to know. As the global economy faces a multitude of challenges, the outlook remains uncertain. Geopolitical tensions, inflationary pressures, and supply chain disruptions are all contributing to a complex economic landscape. Analysts warn that the convergence of these factors could lead to slower growth in various regions. Businesses and consumers are adapting to changing conditions, but the overall economic sentiment is cautious. Policymakers are tasked with navigating these turbulent waters, seeking to implement measures that support growth while addressing inflation. The coming months will be critical as stakeholders assess the evolving situation and its potential impacts on economic stability. The need for proactive strategies and adaptability will be paramount in managing these uncertainties. Global supply chains continue to face significant disruptions, largely attributed to ongoing geopolitical tensions and escalating trade barriers. Major events, such as conflicts and sanctions, have intensified these challenges, making it increasingly difficult for companies to source essential materials. As a result, manufacturers are experiencing delays and soaring costs, leading to a ripple effect across sectors like automotive and electronics. This turmoil has forced businesses to rethink their supply chain strategies, often opting for localized sourcing to reduce reliance on international suppliers. The impact is palpable, with many regions facing product shortages and inflationary pressures. Analysts warn that these disruptions could reshape global trade dynamics for years to come. In response, companies are investing in technology and diversifying their supply chains to enhance resilience. Moving forward, businesses must adopt agile practices to better navigate this volatile landscape and ensure sustainable growth. C3.ai has reported earnings that surpassed market expectations, resulting in a significant 23% surge in its stock price. This impressive performance signals a dramatic change in the perception of AI, according to CEO Thomas Siebel. The company has been at the forefront of providing AI solutions, which are increasingly vital for businesses aiming to enhance efficiency and innovation. This surge comes amid volatility in semiconductor stocks, a sector integral to AI development. Investors are encouraged by C3.ai's results, reflecting a robust demand for AI technologies, even as broader market concerns linger. The strong earnings suggest a potential recovery narrative for AI-related companies, which have faced scrutiny in recent months. As C3.ai capitalizes on this momentum, analysts will be watching closely to see how the company addresses ongoing challenges in the tech landscape. Looking ahead, C3.ai's strategic initiatives may position it as a leader in the evolving AI market. The U.S. metals and mining sector has experienced significant volatility, with shares plummeting nearly 25% in recent weeks. This downturn has raised concerns among investors, particularly as the sector had previously enjoyed a strong performance fueled by increased demand for essential materials. Amid rising inflation and supply chain disruptions, the market has faced pressure, leading to a shift in investor sentiment. However, recent technical analysis indicates potential signs of a reversal, raising hopes for a rebound in the coming months. This shift could be driven by ongoing geopolitical uncertainties, which often prompt investors to seek safer assets. As investors rotate away from high-risk technology stocks, the metals and mining sector may become more attractive. Analysts suggest that if the sector continues to stabilize, it could signal a broader recovery in commodities. The outlook remains cautiously optimistic, yet the potential for further volatility persists, making it crucial for investors to stay informed and agile in their decision-making processes. India is grappling with rising inflation, with retail prices accelerating to 4.38% in June, surpassing the Reserve Bank of India's 4% target for the first time in 17 months. This increase raises concerns about a potential interest rate hiking cycle, aligning India with the hawkish policies recently adopted by the U.S. Federal Reserve. In the backdrop of these inflationary pressures, Indian financial markets have responded positively, with foreign institutional investors injecting over $1 billion into Indian stocks. This marks the largest weekly inflow since June 2025, reflecting sustained investor confidence in India's economic resilience. The government's ability to manage inflation while fostering growth will be crucial in the coming months. Analysts predict that the Reserve Bank will closely monitor economic indicators to determine the necessity of rate adjustments. As inflation remains a pressing concern, the central bank's forthcoming decisions will significantly influence market sentiment and economic stability, setting the stage for potential policy shifts in the latter half of the year. Major banks have reported record profits, showcasing resilience amid market uncertainty. JP Morgan and Bank of America have both posted impressive earnings, driven by a surge in stock trading and robust investment banking activity. Specifically, JP Morgan reported an astounding 86% increase in stock trading, which significantly contributed to its record profit figures. Similarly, Bank of America exceeded profit estimates, fueled by exceptional performance in trading and investment banking. This strong performance contrasts sharply with the challenges faced by the financial sector in the UK, where economic headwinds have hindered growth. The robust earnings from these U.S. banks serve as a stabilizing force in the global markets, providing investor confidence despite geopolitical turbulence. Analysts suggest that these results reflect not only effective management strategies, but also a recovery in consumer demand for financial services. However, the sustainability of these profits amidst ongoing external pressures, such as inflation and interest rate fluctuations, will require careful monitoring. Looking ahead, banks must adapt to evolving market dynamics to maintain their growth trajectory in an unpredictable economic environment. In a startling development for investors, AI-related debt has surged by an astonishing 99% over the past year, a statistic that underscores the rapid financial transformation within the technology sector. This dramatic increase in borrowing is raising alarms about potential systemic risks as companies leverage significant funds to innovate and scale their AI operations. Tech giants like Meta and Amazon are at the forefront, leading a trillion-dollar spending spree on AI infrastructure to maintain their competitive edge. Analysts caution that this influx of debt could test portfolio concentration limits and create vulnerabilities in the market. The financial implications are profound, especially as companies ramp up capital expenditures to meet soaring AI demands. Morgan Stanley has projected record levels of spending, indicating a robust commitment to AI development. However, the swift accumulation of debt raises red flags for investors concerned about sustainability and risk exposure. As the landscape evolves, stakeholders must remain vigilant in monitoring how this debt crisis may influence overall market stability and investment strategies, particularly as interest rates fluctuate. The next few months will be critical for the future of AI investment. Inflation concerns are escalating as the Consumer Price Index, or CPI, rose at an annual rate of 4.2% in May, surpassing the critical 4% threshold. This inflation surge is heavily influenced by recent spikes in energy prices, particularly due to tensions in the Strait of Hormuz, a vital choke point for global oil shipments. Historically, such geopolitical tensions have led to fluctuations in oil prices, impacting transportation and manufacturing costs across various sectors. As inflation is projected to remain above 4% for the foreseeable future, the Federal Reserve faces mounting pressure to maintain its hawkish stance on interest rates. The Fed's current policies are being scrutinized as global economic conditions shift, with pension funds adjusting their hedging strategies in response to the stronger U.S. dollar. Analysts warn that the combination of high inflation and geopolitical uncertainty creates a precarious economic outlook, potentially leading to reduced consumer spending and investment. While markets appear stable for now, this could be a miscalculation. The Fed's decisions in the coming months will be critical in determining whether the economy can navigate these turbulent waters without triggering a recession. The semiconductor sector is currently navigating a turbulent landscape with significant volatility affecting key players. Recently, SK Hynix experienced a dramatic decline in its stock price, raising alarms among investors about the sustainability of the AI capital expenditure boom. This drop has caused a ripple effect throughout the semiconductor industry, leading to a unanimous sell-off in the SOX index. Companies like Micron are also feeling the pressure as the market undergoes a significant shift, highlighting the interconnectedness of the sector. As analysts prepare for ASML Holdings' upcoming earnings report, which is anticipated to show a 15% rise in year-over-year earnings per share, the immediate focus remains on the broader implications of these stock movements. The uncertainty surrounding AI spending and high valuations is fueling apprehension among investors, as many are questioning whether the current hype can be sustained in the long term. Technical analysts warn that the sector is in a volatile downtrend, raising concerns about the future of chip stocks. Moving forward, ongoing scrutiny of AI spending narratives will likely continue to impact investor sentiment, making it essential for stakeholders to remain vigilant in monitoring market reactions. The coming weeks will be critical in determining the sector's trajectory. The geopolitical landscape has shifted dramatically as Iran and the United States have announced rival blockades in the strategically vital Strait of Hormuz. This escalation in military tensions threatens to unravel a fragile ceasefire that had held for 4 months, raising fears of potential conflict. The Strait of Hormuz is a critical choke point through which approximately 20% of the world's oil supply passes, making any disruption here particularly concerning. The immediate consequence of this clash has been a significant spike in oil prices, with Brent crude reaching $78.68 per barrel, a level not seen in over a year. This rise in oil prices has triggered a sharp sell-off in chip stocks and U.S. index futures as investors react to the perceived instability in global markets. The semiconductor sector, already under pressure from supply chain issues, saw SK Hynix suffer a staggering 15.37% drop, marking its worst day in 18 years. Analysts are now concerned that this oil shock could push U.S. inflation above 4% for the first time in 3 years. The Federal Reserve, which has maintained a hawkish stance on interest rates, now faces a complicated path forward as high inflation could stall the economic recovery. With tensions escalating, investors are reevaluating their strategies, particularly in sectors sensitive to oil prices and inflation trends, anticipating more volatility ahead. Thank you for watching today's top stories. Which story shocked you the most? Don't forget to like, share, and subscribe for more updates.